Hello and welcome to the ninth of our lecture recaps on CIMA P3 Performance Strategy. This lecture is on conducting an audit. First thing we looked at was our audit planning. So what were the contents of our audit plan? Well, firstly it defined the scope of the audit and sets out the objectives. Secondly, it sets out the nature of the audit, and this tells us what standards we're going to use and what evidence we're going to collect. Lastly, it tells us the timing of the audit. What is our timetable? When do we want to have it done by? The ICE set out that we should undertake a risk-based audit as opposed to a systems audit. We'll conduct a risk assessment and then we'll focus on the risk areas. So how do we do our risk assessment? Well, we're looking at what's called audit risk. Audit risk is the risk of expressing an inappropriate opinion. Remember that the auditor is stating an opinion on the financial statements as to whether they provide a true and fair view. So the risk is that he says they are a true and fair view when they're not, or that they are not true and fair when in fact they actually are. So that's the risk of expressing an inappropriate opinion. The formula for audit risk is inherent risk times control risk times detection risk. So let's look at each of those types of risk. Firstly, inherent risk. Inherent risk is the risk inherent in that type of business. For example, you want to think of maybe a cash-based business. There'll be inherent risks in a cash-based business, i.e. the risk that cash goes missing, the risk that management are filtering off cash, those sorts of inherent risks. Or the type of industry that they're involved in. For example, fast-moving industries, there's a high inherent risk that your technology goes out of date. So those are examples of inherent risk, risks inherent to the business. Control risk then. Control risk is due to inadequate controls. So it may be that you need to test these controls, decide if they're adequate, and that will determine your control risk. Remember, with all of these, we're looking at the risk of a material misstatement in the financial statements. Detection risk then is simply the risk that you don't find an error that exists. So when do we conduct our risk assessment? Well, we'll conduct one at the planning stage, or when we're making recommendations for new controls, or for improvements to current controls. Materiality then. How do we decide what is material? Well, if it's likely to influence the user of the financial statements, an item is said to be material. On a quantitative side of things, it may be a percentage of your turnover, or a percentage of your net assets if you wanted to quantify materiality. But remember that materiality is not just quantitative, it can be determined by the nature of the balance, because it'll give us an indication of the control environment that exists. So a failure in some sort of control, such as petty cash, may indicate that the control environment isn't as strong as you would like and increase your control risk, which in turn then will increase your audit risk. When do we consider materiality? Well, we consider it at the planning stage, obviously, we'll set it then. But we'll also look at it at the end of the audit in the evaluation stage. So that was our risk assessment. Obviously, to audit a system, you're going to have to really understand it. Why do we need to understand it? Well, we're going to look in detail at the processes, so we need to understand them. We're going to evaluate the controls, so if you don't know what controls are there, you can't evaluate them. And you're going to design tests to test the control, so you need to have a strong understanding of them. So you'll maybe document the system. This might be through a flowchart, or interviewing the employees, or simply by observing the day-to-day running of the business. That will give you a good documentation of how it runs. You also need to ascertain the controls. So firstly, you'll have internal control questionnaires. These will tell you what the controls actually are. You'll then have internal control evaluation questionnaires, and this will tell you how likely the control is to actually work. So those two things will give you a strong understanding of the controls and you will then understand the system. So we then need to move on to testing the system. There's two types of tests. The first type of test is substantive testing. Substantive testing is the testing of a balance rather than the testing of a control. For example, you might add up all the debtors' balances and check that it comes to the same figure as the financial statements. That's substantive testing. The other type of testing is tests of control. Tests of control focus on the controls in the system and test whether they're working correctly. For example, on the sales cycle, we'll maybe do sequential checks to make sure that there are no invoices missing. We'll check for authorization of goods delivered notes. We'll check for authorization of credit notes. We'll look for evidence of invoice checks, that the invoices are added correctly, the correct prices on them. We'll check that the goods delivered notes are matched to an invoice, and we'll look for evidence of regular reconciliations. So all of these are tests that controls are in place. On the purchases cycle, you might look at whether the invoices are signed, are they checked, are the credit notes agreed to an invoice, are the purchase orders signed, and are there regular supplier statement reconciliations. Again, all these controls should be in place. You're just testing to see whether they are or not. On the payroll cycle, you'll look to see whether the timesheets are approved, whether the wages are distributed and observed, whether any amendments to standing data are approved by managers, and you'll then inspect the reconciliations. Again, all these tests will test whether the controls are in place. Inventory, then, you'll have sequential checks. You'll observe security, you'll check that write-offs are authorized, and you'll check that movements are authorized. For bank and cash, you'll check that there's segregation of duties, that the sequential checks are carried out, that check procedures are followed, that there are regular bank reconciliations, and that there are controls over petty cash. So you'll check all of those things, undertake tests to make sure those controls are in place. A couple of areas then we need to discuss. Obviously you can't check that every invoice is authorized, or that every invoice is checked, or every credit note is agreed to an invoice, so you're going to undertake sampling. You're going to do it on a sample basis. Sampling means you don't test 100% of the balances, you take a sample. So we have different types of sampling. We can do stratified sampling. This means that you take certain sections and you concentrate on those. Systematic sampling, for example, every third invoice or every fifth invoice, that would be a systematic sampling. Or block sampling. This means that you take large blocks of samples from certain areas. Or random sampling, using statistical techniques to undertake random sampling. Another area we want to look at is analytical review. Analytical review is the use of ratios to identify trends. Okay, so you might look at your gross profit percentage over a period of time and see, is there a trend that should be established. If there's a deviation from that trend, it might indicate a risk area and something that you want to look at. So you'll use these in the planning and review stage. In your planning stage, you'll look at the financial statements, look at the movements this year compared to last year, identify trends, and then look for any deviations away from those trends. For reporting then, we may have an audit report that includes our objectives first of all. It'll tell us the process that was undertaken to do the audit. It'll give us our test results. It'll express our audit opinion, and it'll give us some recommendations. So that was how to conduct an audit.